Namaskar dosto, welcome back to Dwaj Stock Info. Today we are going to discuss one very good interesting topic, mutual fund versus direct stocks. Which one is actually better for you in 2026? Let me start with a question. How many of you had this agreement with your friend or a family member? I invest in mutual fund. They say mutual funds are the people who do not know what they are doing, and the direct stock is where the real money is. Or your friend invests in a direct stocks and you say that is too risky, just do a SIP in a good mutual fund. Whoever wins this argument, raise your hand. The truth, both of you are partially right and both of you are partially wrong. In the next few minutes I am going to give you the honest, data-backed, balanced answer for this question so that you never have an argument about it again. Before we compare them, let us make sure and understand what each one is actually in plain English. The mutual fund is like hiring a professional cricket team to play match on your behalf. You give them money, the fund manager, the captain decides which stocks to buy and sell, the team plays the match and you collect the runs or wickets. You do not need to be on the field, you do not need to know every player, you trust the captain. Whereas in case of direct stocks investment, like you stepping into your own field yourself, research the players, you decide who to pick and the bat and ball yourself. The reward can be higher but the responsibility is entirely yours. Both approaches can win. The question is which one is your skills, your time and your temperament. Now I want to compare these two approaches across 8 each dimensions. This is the most comprehensive comparison you will find on the YouTube India. Stop this video right now, screenshot this. The green cell show where each option has the advantage. I will walk through all each one by one. Factor number 1, minimum investment. Rupees 500 a month a SIP starts today. Direct stocks 10 to 15 lakhs for meaningful diversification. Then next factor, time required. For mutual fund, minimum quarterly review is sufficient. In case of direct stocks, high research monitoring decisions daily required. Then next is the diversification. In case of mutual fund, instant 40 to 60 stocks is one fund, but in case of direct stocks you must build yourself stock by stock. Then the next factor, return potential. In case of mutual fund is very good, index funds match market returns. In case of direct stocks, higher potential but requires skill and discipline. Next factor, cost or fees. Active 1% to 2.5% per year, index funds 0.1 to 0.2%. Whereas in case of direct stocks, of course, brokerage is very low, no annual management fees required. Next factor is expertise needed. In case of mutual fund, none. Fund managers handles everything. In case of direct stocks, high fundamental plus technical analysis needed always. Then comes next factor, emotional control. In case of mutual fund, it is built in. SIP enforces the discipline. In case of direct stocks, difficult. Emotions drive most retail players lose. Then next factor is flexibility. In case of mutual fund, it is limited, daily NAV based, no intraday. In case of direct stocks, full buy and sell anytime the market is open. Then next factor is tax, long-term capital gains. In case of mutual fund, 10% above 1 lakh for the equity MF is simple. In case of direct stocks, 10% long-term capital gains, same rate but more complex and more track. Next factor is transparency. In case of mutual fund, monthly portfolios disclosed, regulated by the SEBI. In case of direct stocks, full, you know exactly what you own always. Now let me share some numbers that most of YouTube channels will never tell you because they are not comfortable with the data. Ready? First one, 70 to 80% of actively managed equity mutual funds in India underperform their benchmark index over 10 years or more after fees. Source, SPIVA India 2024 and PrimeInvestor 2025. Fact number 2, 65% of large cap mutual funds in India fail to beat the Nifty 50 index fund. Not because the fund managers are bad, but because they charge 1 to 2% in annual fees and the fees eats the outperformance. A Nifty 50 index fund charges 0.1% to 0.2%. The math is brutal. Fact 3. A top mid-cap fund delivered 28.5% CAGR over the 3 years. In the average 5-stock direct portfolio delivered 19% CAGR. The fund won with less stress and fewer sleepless nights. But fact 4. 40 to 45% of the active Indian funds do beat the benchmark over the rolling 3 years period. So some active managers are consistently excellent. The challenges is identifying them in advance. What this means for mutual fund and for direct investors. We'll go one point by point. Choose index funds over most active large cap funds. The 0.1% to 0.2% expense ratio versus 1% to 2.5% makes a massive difference over 20 years. In case of direct stocks, most retail investors underperform even mutual funds in direct stocks because the emotional decisions, buying peaks, selling in dips. Next, always choose direct plan over the regular plan. 45% of AUM is in the direct. Join them. You have the distributor commission. In case of direct stocks can be found if you have 5+ years of deep research experience, iron discipline, and 15 lakhs plus a build meaningful diversification. Rather than giving you a simple answer, because there is no single correct answer, let me describe 4 types of Indian investors and tell you what works best for each. Listen carefully. One of these is for you. Investor type 1. The busy professional, salaried, 28 to 45 years, limited time. Best suits for works 9 to 6, has 5 to 25,000 to invest monthly, cannot monitor stocks daily, want wealth creation without stress. My recommendation is start with Nifty 50 index fund, SIP immediately, add a flexi cap fund, later consider a mid cap fund, keep 80% in mutual fund, only add direct stocks after 3+ years of market study. Then in case of investor number 2 type, a curious learner, any age, want to understand markets perfectly, best suited for, has watched episodes 1 to 9 this series, knows fundamental and technical analysis, has 2 to 4 hours of week of research. My recommendation, split 20-60% mutual fund core stable base plus 40% direct stocks, maximum 10 to 15 carefully researched stocks. Episode 1 to 8 is the series, have given you the foundation to start the direct investing confidently. In case of investor type 3, the retirees or the pre-retirees, 50 years plus, capital preservation priority, best suits for needs stable income, capital protection, cannot afford large losses, dividend income from episode 8 is relevant here, lower risk tolerance. My recommendation is 60 to 70% of debt mutual funds or hybrid funds, 20 to 25% in quality dividend paying direct stocks, has covered in episode 8, 5 to 10% in liquid funds for emergency access. Then in case of investor type 4, the experienced investor, 5+ years of experience, deep research and capability, best suited for, has studied and has annual reports, episode 4, understand technical analysis, episode 5 to 7, has 25 lakh plus investable income, has survived at least one market crash without panic selling. My recommendation is core of 40 to 50% in direct stocks, high conviction, well researched business, 30 to 40% index funds, has market exposure, 10 to 20% of the stock specific mutual funds or areas outside your experience. The golden hybrid approach. Now let me share what I call a golden hybrid, the approach that most of the financially successful Indians I know actually use. They do not argue about the mutual funds versus direct stocks. They use both deliberately, strategically. Here is how it works. Your core portfolio, 60 to 70% goes into the low cost index funds, Nifty 50 next, perhaps the mid stock index. These give you broad market returns with almost zero effort. Your satellite portfolio, 20 to 30%, goes into the 5 to 10 direct stocks in the business you genuinely understand. Companies in your own industry, companies whose products use every day, businesses you have researched deeply using the framework from episode 2 of this series. Your income portfolio, 10% goes into the quality dividend packing stocks or debt funds. This generates regular income as covered in the episode 8. 3 layers, 3 purposes and 0 arguing. So let me give you your action plan for today. Step 1, go to mfcentral.in or Zerodha Coin or Grow. Check you are invested in a regular plan mutual fund. If you are, switch to direct plan. That one switch could save you 0.5% to 1% every year. Over 20 years, that is lakhs of rupees. Step number 2, if you do not have a SIP yet, start on today. Even 500 rupees per month is enough. A Nifty 50 index fund. Every month that you delay is compound interest that you never get back. Step 3, if you want to try direct stocks, do not start without reading at least 3 annual reports using the framework from episode 4 of this series. Study before you invest. Come back to the comments and tell me which investor profile from today's episode describes you the best. And you are busy professional, curious learner, the retiree or the experienced investor, comment your profile. I reply to every single comment every day. This episode settles the debate for you. Debate with your friend and family members you have been arguing with. See you in episode 10 where we tackle portfolio building for each of these investors. Please like, please share and please subscribe and support so as to bring more and more good videos for you. And I would like to clarify again, and this is for only educational purpose only. I am not making any specific recommendation. Thanks for watching.